Welcome to the deep dive. Have you ever felt, caught in that classic finance bind, feeling like you have to pick a side, traditional investing or crypto, safe or risky?
Oh, absolutely. It's this feeling that you're forced into one camp or the other.
Exactly. That sort of internal tug of war. So many investors feel that pressure, like these worlds just can't mix.
And honestly, that whole idea, it feels really outdated now, doesn't it? The financial world has changed so much. Our strategies, they need to catch up.
They really do.
Thinking you have to, like, it's traditional finance versus digital assets.
Yeah.
That's just not how it works anymore. There's a much better way, a more dynamic path that actually uses the best of both.
Right. And that's exactly what this deep dive is all about today. We want to give you a real concrete blueprint, like an actual strategy you can think about using.
A tangible plan.
Yeah, for what your personal investment portfolio could look like in this hybrid world we're in now. We're trying to move past that rigid either or thinking.
And step into more of a both-hand approach, leveraging, the synergy between different kinds of assets.
We're talking actual strategies here, things you might consider putting into practice.
Precisely. And the main strategy we're going to unpack today is the core satellite investment model.
Okay, core satellite. I've heard that term. Sounds kind of traditional.
It is. It's a classic from traditional finance, definitely time-tested through all sorts of market ups and downs, decades, really. But what's super interesting now is how well it fits into a hybrid setup.
Ah, okay, so it translates.
Perfectly. It's almost like it was designed for this moment, for integrating these newer digital assets. It gives you that stability, but also, importantly, room for growth.
Okay, stability and growth. That does sound like the holy grail for a lot of investors, right? How do you get that innovation buzz without, losing sleep at night?
Well, it's all about building a portfolio that's balanced from the start, resilient, but also looking forward.
So you can dip your toes into new stuff like crypto innovation, but still feel secure.
Exactly. You maintain that foundational security so you can sleep at night. It's not about giving up one for the other. It's about smart allocation to get both. So let's break down how this actually works.
Let's do it. So maybe an analogy would help here to really get how to build this kind of hybrid portfolio.
Yeah, analogies are great for this. Imagine your whole investment portfolio is like a solar system.
Okay, a solar system. I like that.
It helps visualize the different parts, what they do, how they all connect within your financial universe.
All right. So in this solar system, what's the sun?
The core is your sun. It's the massive central thing everything else orbits around. It's the anchor.
The anchor. Okay.
So for your portfolio, the core is the absolute bedrock. It's designed specifically for stability, long-term security, and getting those steady broad market returns over time.
So it's the part that should ideally ride out the bumps.
Exactly. It's engineered to handle market swings, give you confidence, continuity, through different economic times.
Yeah.
It's not about hitting home runs. It's about reliable compounding, steady growth.
Okay, so the core is the sun, the stable center. What specifically goes into that core? What defines these investments, whether they're traditional or maybe digital?
Right. Core investments are those foundational, stable, long-term assets. They're basically the ballast keeping your whole portfolio grounded, like an anchor, keeping things steady even when the surface is choppy.
So you're not checking these every hour.
Definitely not. You're trusting them to compound steadily over years, maybe decades. They should provide that sort of steady upward path for the biggest chunk of your money.
And what about how they behave? Because, for peace of mind, knowing what to expect is huge.
Absolutely key. These assets tend to have lower volatility compared to, say, really speculative stuff. They don't bounce around erratically week to week.
Okay.
Instead, you pick them because they have a real use case, a solid history, or they play a fundamental role in the economy or maybe a new technology. That steadiness is what helps you sleep at night, especially when markets get turbulent, which they inevitably do.
So they're backed by something solid, not just hype.
Exactly. Robust fundamentals, broad market performance, not just some fleeting trend. They offer a sense of predictability, enduring value.
Okay, let's get concrete then. Give us some real examples. What are we actually talking about for core investment? What are some tangible strategies people can look at?
Sure. On the traditional side, you've got things like low-cost exchange-traded funds, ETFs, especially ones that track broad market indices.
Like the S&P 500.
Exactly. An S&P 500 ETF is a classic example. Gives you instant diversification across 500 of the biggest U.S. companies. Or maybe a total market ETF, which holds thousands of companies, sometimes even globally.
And they're pretty efficient, right? Low fees.
Incredibly efficient, very cost-effective. They're built to capture what we call market beta, basically the overall growth of the economy, without the hassle or higher fees of trying to pick individual stocks or using actively managed funds.
Yeah.
Their job in the core is just steady, diversified returns that mirror the economy.
Okay, ETFs make sense. What about individual stocks? You mentioned blue chips.
Right, blue chip stocks. Think of the giants, the household names. These are shares in big, established companies with long track records of making money, often paying dividends.
Commodities that have been around the block.
Exactly. They usually dominate their industries. They've weathered recessions before. Global leaders, their role in the core is to offer a mix of stability and that steady compounding return. It adds another layer of reliability alongside the broad index ETFs. Still growth, but generally lower risk than smaller, newer companies.
Now, here's where the hybrid idea really kicks in. A lot of people still see crypto as, well, pure speculation. Can digital assets really be part of the core? How do you justify that?
That's a great question, and it really gets to the heart of the hybrid approach. The answer is yes. Certain digital assets, mainly Bitcoin and maybe Ethereum, can absolutely be part of the core, for a significant chunk even.
Okay, but with a condition.
Yes, a big one. It's only if you, the investor, have a really strong long-term belief in their fundamental value, their technology, their network effects, their potential role in a future financial system. It has to be a deep conviction.
So not just because the price is going up?
Definitely not. For Bitcoin, the argument for it being core often comes down to its fixed supply, its decentralization. Proponents see it as digital scarcity, kind of like digital gold.
A store of value.
Potentially, yeah. For a long-term holder, it might offer a hedge against inflation, maybe move differently than traditional markets, a bet on a new censorship-resistant value store. Ethereum, on the other hand, is more like the foundation for a decentralized internet. Smart contracts, DeFi, NFTs.
So it's a bet on that whole ecosystem.
Exactly. A foundational bet on programmable money, the future of online stuff. So again, it's not about day trading. It's about believing in their long-term utility and staying power as core infrastructure. It's a different kind of core asset.
Okay, that makes sense. So whether it's traditional ETFs, blue chips, or maybe Bitcoin or Ethereum, if you have that conviction, why do these things make up the majority of the portfolio? What's the big why behind the core being so dominant?
It's pretty simple, but really important. They provide those consistent broad market returns, and, crucially, they reduce the overall ups and downs, the volatility of your entire portfolio.
So they act like shock absorbers.
Perfect analogy. By anchoring most of your capital in these stable, diversified assets, you build a strong base. This base is designed to soak up the hits from the more volatile satellite investments we'll talk about later.
So you still get general market growth, but without being totally exposed if one risky bet goes wrong.
Precisely. And it minimizes that emotional roller coaster, right? The stress that comes with only holding high-risk stuff. It helps you stay invested. Even when the market dips, it's your anchor in the storm. Gives you peace of mind.
Okay, and the size, you mentioned it's the majority. What kind of percentage are we talking about for this core?
Typically, yeah, the core is a big chunk, often somewhere between, say, 60 to 80% of your total portfolio.
60 to 80%, that's significant.
It is. And it's designed that way, so the bulk of your wealth is working for you relatively safely, diversified, stable, compounding over time.
But it's not like 72% is the magic number for everyone, right? People's situations are different.
Not at all. That range, 60 to 80, it's definitely not rigid. It really, really depends on your age, goals, and risk tolerance. This is where you tailor it to yourself.
How so? Give me an example.
Okay, well, a younger investor, maybe in their 20s or 30s, they've got a much longer time horizon before they need the money, like for retirement. So they might lean towards the lower end of that range, maybe 60% core.
To leave more room for growthier stuff.
Exactly. More room for those potentially higher growth satellite investments. They simply have more time to recover if some of those riskier bets don't pan out.
Okay, so for you listening right now, how do you figure out your ideal core size? What should you be thinking about?
You've got to look inward, really consider your unique situation. Why is your age important? What are your specific financial goals? Buying a house soon, retiring in 5 years, saving for kids' education, all that matters.
And crucially, your comfort with risk, right? How much volatility can you actually stomach?
Paramount, absolutely paramount. If you're closer to retirement, or maybe you just have a lower risk tolerance naturally, and your main goal is just preserving the capital you have, then A larger core makes sense, maybe 75%, maybe even 80%.
Why? What does that larger core give you?
It provides much greater security. More of your wealth is shielded from those wild market swings. It means you have a reliable pool of money when you actually need it. A bigger core also just means less exposure overall to potential big drops in those speculative assets.
Which helps with the stress levels.
Massively. It helps you avoid those emotional knee-jerk reactions like selling everything when the market dips.
Mhm.
It's about aligning your portfolio not just with your financial plan, but also with your own psychology, what lets you sleep peacefully.
Okay, fantastic. So we've really cemented the core, our stable sun, the gravitational center, providing that foundational stability, those consistent returns.
Yeah.
Now, let's talk about the orbiting stuff, the planets, the moons.
Yes. This is where hybrid investing, as you said earlier, really gets fun.
This is where you explore.
Exactly. It allows for that strategic exploration, targeting innovation, trying to capture those specific, maybe faster growth opportunities that are often happening at the cutting edge.
So if the core is the sun, satellites are the planets and moons orbiting it, representing what?
They represent those targeted higher potential plays. They might be more volatile, sure, and maybe need a bit more watching, but they offer the chance for bigger returns.
How? By focusing in.
Yeah, by concentrating on specific emerging trends or high growth sectors or maybe disruptive technologies, they let your portfolio be a bit more nimble, more opportunistic.
So define these satellite investments more clearly. What's their specific job in the portfolio? What are we trying to do by adding them?
Satellites are where you explore trends, sectors, or altcoins. Their main purpose is to offer that potential for higher returns than the core
How?
by letting you put capital into specific, often fast-moving opportunities that a broad market index might not really capture. They let you be more agile, maybe capitalize directly on big innovations, aiming for alpha,
Yeah.
right? Returns above the general market.
Taking calculated bets on the future.
That's a good way to put it. Calculated, concentrated bets on future growth areas.
Oh, hey, this sounds exciting. So what kind of assets actually fall into this satellite bucket? Both traditional and digital examples would be great.
Definitely. On the traditional side, you could look at things like emerging growth stocks,
Small caps.
often small or mid-cap companies, yeah.
Mm.
They've got significant potential to grow fast because maybe they have a unique technology or a new business model or they're tapping into a new market. But
Higher volatility.
inherently higher volatility, yes. They're usually younger companies. Maybe their path isn't as clear as a big blue chip.
Mm.
But the potential upside, if they execute well, can be huge. Think of them as the startups of the public stock market.
Okay. And in the crypto world, you hear a lot about DeFi yields. Is that a satellite play?
Absolutely.
Uh-huh.
High-yield decentralized finance, or DeFi projects, they can offer really substantial returns, often much higher than you'd find in traditional finance for similar things.
Like what kind of things?
Strategies like providing liquidity to decentralized exchanges,
Yeah.
DXs, or lending out your crypto on platforms, or yield farming. But, and this is a big, but they come with unique risks.
Beyond just the price going up and down.
Yes, you've got smart contract risk bugs or hacks in the code. There's impermanent loss if you're providing liquidity and prices move against you. And there's still a lot of regulatory uncertainty in DeFi. It's evolving fast.
So high potential reward, but requires serious homework.
Rigorous due diligence is non-negotiable. You need to understand the specific protocol, how it works, the risks involved, the security audits. It's not passive income in the traditional sense.
What about thematic investing? Betting on big trends like AI or clean energy.
Classic satellite strategy. You make concentrated bets on specific sectors you believe are poised for massive long-term growth. Clean energy, AI, biotech, cybersecurity, the metaverse, whatever you think is the next big thing.
Investing in the future, basically.
Right. But the risk is concentration. You're betting heavily on one story playing out. If that theme doesn't take off as you expect or the companies involved stumble, your investment can suffer. But if you're right, the rewards can be significant. It's about backing innovation.
And then, of course, the rest of the crypto world beyond Bitcoin and Ethereum, the altcoins.
Correct. Diversified altcoins. These are other cryptocurrencies you might choose for a specific use case or a tech breakthrough or a market trend that Bitcoin and Ether don't really cover. Maybe a blockchain focused on supply chains, or a privacy coin, or decentralized storage, or an NFT platform. They offer exposure to the wider innovation across crypto.
But higher risk again.
Generally, yes. Potentially higher volatility, shorter track records than BTC or ETH. Each altcoin has its own specific risks and potential, linked to its tech, its team, its adoption. Requires a ton of research to sort the promising projects from the less viable ones.
Okay, so lots of exciting, higher potential options in the satellite space. But you mentioned risk multiple times. There's a really critical point here about managing that, right? It comes down to one key word.
Yes. And that word is proportion. This is so, so important. Satellites are exciting, yes, but you have to be mindful of how much of your total portfolio you put into them.
Why? What's the danger?
The danger is overallocation. Seriously. You don't want your entire net worth riding on one moonshot or even a few highly speculative bets. That's how people get wiped out.
Oh.
It can lead to huge losses and just immense stress.
Yeah, you see people going all in on something speculative, and then they're glued to the price charts, freaking out. It's the difference between being strategic and just being stressed.
That's exactly it. The crucial distinction between being strategic with satellites
Yeah.
and being stressed out because you took on way too much risk.
How do you define strategic here?
Strategic means you've done your homework, you understand the risks involved,
Yeah.
and you've sized your position appropriately so that even if it goes terribly wrong, even if it goes to zero, it doesn't wreck your overall financial health or your long-term plans.
And stressed out is the opposite.
Stressed out means you put too much in. Every little market wiggle makes you anxious. You start making bad decisions based on fear or greed, panic, selling low, maybe FOMOing in high. It's a terrible cycle.
So for you listening, why is managing that satellite allocation size just so vital? For your money, but also just your sanity.
It's about protecting your downside while still giving yourself a shot at significant upside. A smaller, carefully chosen satellite allocation, let's say maybe 10%, maybe 20% max of your total portfolio, lets you have that excitement.
Participate in new trends.
Yeah, participate in those cutting-edge things, maybe learn a lot, potentially make really good gains, but crucially, without risking your core foundation. It's like having an innovation budget.
An innovation budget. I like that.
Yeah, it contributes to growth, but within safe limits, and it forces you to be honest with yourself about your risk tolerance. Could you really handle losing this amount? If the answer is no, the position is too big. That self-awareness and discipline and sizing, absolutely key for long-term success and just staying calm.
Okay, brilliant. We've established the core, our stable sun. We've explored the satellites, the dynamic planets. Now let's make this real. Abstract ideas are good, but people need something concrete, right? A blueprint.
Exactly. Time to bring it all together into something practical you can actually look at. A starter framework.
A tangible, actionable blueprint for your hybrid portfolio. Something simple enough to get started, but that shows these core satellite ideas in action across both traditional and crypto.
Bridging that gap from theory to practice.
Okay, but first, the big flashing warning sign.
Yes. Super important disclaimer. Not financial advice. Cannot stress that enough.
Right. This is just a framework, an example to guide your thinking. It's meant to empower you to understand the structure so you can adapt it to your situation. It's not a prescription.
Think of it like a customizable template, not gospel. Okay, so let's break down the starter kit allocation. Remember, these percentages are just examples, a solid starting point to consider.
Got it. First up, the biggest piece, the bedrock. 50% in core ETFs, like those S&P 500 or total market funds we talked about.
Right. This 50% is your main foundation. Broad, diversified exposure to the stock market, designed for stability, long-term growth, low-cost, liquid, tracks the major indices. It's about capturing that overall market growth passively.
Okay, 50% ETFs. Next.
Next, let's bring in some digital, but on the stabler side. 20% in stable coins or yield-generating crypto.
Ah, okay. So this shows crypto isn't just speculation. How does this work?
This is really interesting. Stable coins like USDC or maybe USDT are pegged to something stable, usually the US dollar. So they let you hold value within the crypto ecosystem without the wild price swings of, say, Bitcoin.
Capital preservation, but digital.
Exactly. And the yield-generating part means using those stablecoins or maybe other staked assets to earn interest. Things like staking, lending on DeFi platforms, providing liquidity. It can offer passive income, often at higher rates than a bank account.
So crypto used for stability and income. Interesting. That's 70% total so far. What's next?
Next, 15% allocated to blue-chip stocks or established crypto.
Okay, so a choice here.
Yeah, flexibility. This slice is for those established, reliable assets focused on long-term growth from strength. You could put it in those traditional blue-chip companies we discussed, or, if you have that long-term conviction, in Bitcoin or Ethereum.
So this bridges the gap between broad market and more specific bets.
Exactly. It focuses on quality assets, market leaders, known for resilience and compounding. Whether traditional or digital depends on your view.
Okay, 50% ETFs, 20% stable yield crypto, 15% blue chip established crypto. That's 85%. Now for the spice.
Now for the spice, the satellites, and 10% in satellite plays. This covers those growth stocks, DeFi projects, specific trends.
So this is that innovation budget allocation.
Precisely. This 10% is your dedicated space for the higher risk, higher reward stuff. Exploring small cap growth stocks, carefully researched DeFi opportunities, thematic bets on AI or clean energy, maybe some specific altcoins.
Higher potential, but contained.
Exactly. It lets you make those targeted bets, participate in the cutting edge, but without risking the farm. It's your engine for potential outsized returns, but kept to a manageable size. Calculated risk-taking happens here.
Okay, that brings us to 95%. What's the last 5%?
The last 5%, often overlooked but critical. Cash or maybe very safe bonds for flexibility and liquidity.
Why is cash so important?
Absolutely crucial. This is partly your emergency fund buffer within your investment portfolio. It stops you from having to sell core assets at a bad time, like during a market crash, just because you need money.
Right, avoids forced selling.
But it's also strategic. It's your dry powder. When markets correct and quality assets suddenly go on sale, having cash lets you seize those opportunities. Buy the dip, right?
Instead of just watching prices fall because you're fully invested?
Exactly. It gives you flexibility to act. And for someone really risk-averse, maybe this 5% is even a bit higher, just for that extra psychological comfort.
Okay, that allocation, 50% core ETFs, 20% stable yield crypto, 15% blue chip established crypto, 10% satellites, 5% cash bonds, paints a really clear picture. What's the philosophy this embodies? You had a great phrase for it.
Yes, it really gives you a portfolio with roots and wings. It's not just catchy. It sums up the whole hybrid core satellite idea perfectly.
Roots and wings. Let's break that down. How do the roots show up in this allocation?
The roots are your core components. The ETFs, the stable coins, the blue chips, or established crypto. They provide that deep, solid stability. They're your financial anchors, grounding you through market storms.
Designed to protect capital and grow steadily.
Exactly. They weather the storms, give consistent returns, protect your principal. They offer that sense of security, that strong base from which everything else can grow. Your financial future is rooted in strength, reducing anxiety.
Okay, so those are the deep roots. What about the wings? How does the starter kit let your portfolio fly?
The wings are your satellite components, that 10% allocation to growth stocks, DeFi, altcoins, trends. They let your portfolio explore new heights.
Reach for higher growth.
Yeah, participate directly in the most innovative, fastest-growing parts of the market. Capture those opportunities. They allow you to be dynamic, take calculated risks, potentially generate that alpha returns above the market.
So they give your portfolio the power to soar.
Precisely. To soar and capitalize on what's next, financially and technologically. It's that balance. Grounded and stable, but also free and capable of reaching for much more. Calculated risk for potentially disproportionate reward.
So for you, the listener, thinking about this, how do you actually adopt this mindset? Move from just hearing about roots and wings to actually building it?
By taking this framework, this starter kit, and using it as a concrete starting point for your own thinking and research. These numbers, these asset types, they make the abstract ideas actionable.
It gives you a path.
A clear, tangible path to start building your hybrid portfolio, one you can then tweak based on your profile. It's about taking control, understanding of why each piece is there, its strategic purpose.
Making informed decisions aligned with your goals and comfort level.
Yes, it helps you become a more deliberate, confident investor, moving away from just reacting emotionally to market noise, towards building something robust for the long term.
Okay, fantastic. We've broken down core, satellites, given a tangible starter kit. Let's really hammer home the big strategic advantage of this whole hybrid approach. What makes it different, better maybe, than just picking one side?
The biggest advantage, and honestly the most liberating part for many, is simple. You don't have to choose between boring and risky.
Escaping that false choice.
Exactly. This core satellite hybrid strategy frees you from that dilemma that trips up so many investors. You're not forced into either. You get to embrace a powerful both-hand approach.
Combining the best of both worlds.
Pretty much. You use the strengths of traditional assets and innovative digital assets.
How does the strategy actually achieve that integration so smoothly?
Well, it allows you to build that solid base with your core parts, the ETFs, stablecoins, blue chips. That gives you the stability, the broad market exposure, the steady compounding. But at the same time,
You keep the door open for growth.
exactly. It enables you to Stay open to growth, to capitalize on those new, maybe higher risk but higher reward opportunities through your satellite allocation. You genuinely get the reliability of the established stuff and the exciting potential of the new stuff. That balance is key for a resilient, adaptable portfolio.
And it changes how you think about investing, too, right? It's less about chasing tips, more about building a system.
Huge mental shifts. The more you start to think in terms of systems like this core satellite model, honestly, the smoother the journey gets. It's so much better than constantly chasing the latest hot tip.
Why are hot tips so bad?
Hot tips are usually reactive, based on hype, maybe fear, maybe incomplete info. They rarely lead to consistent success long term.
Right.
They cause stress. You end up buying high because everyone's talking about it, then selling low when the hype dies. It's a recipe for disaster.
So why does a system like Core Satellite reduce that stress and lead to better results over time?
Because a system gives you a clear framework for decisions. It reduces stress because you know the plan. You understand why each investment is there, what job it's supposed to do.
So you're less likely to panic.
Much less likely to panic sell during a downturn because your core is built for that. You're also less likely to chase some random coin that's mooning because your satellite allocation is already defined and sized appropriately. You make rational decisions based on your strategy, not emotion.
Leading to more discipline, better outcomes.
Way more disciplined and usually significantly more successful investing over the long haul. You're building a robust machine that works in different conditions, not just reacting to every headline.
Okay, let's do a super quick recap then. Core versus satellite, the key differences that make this hybrid approach work for your portfolio.
Okay, core. Think stability. It's the bulk, the majority of your portfolio. It's long-term focused, gives you broad market exposure like through ETFs or solid blue chips. Lower volatility, it's your bedrock. Steady compounding.
Got it. And satellite?
Satellites. Think growth, innovation, targeted opportunities, smaller part of your portfolio, strategically sized. Might be shorter to medium-term plays or bets on specific trends, concentrated exposure to cutting-edge stuff. Higher volatility, higher potential return, your targeted growth engine.
And the magic, the hybrid power, is putting them together.
That's the synergy, combining the stability and compounding of the core with the growth potential and dynamism of the satellites. That blend creates a portfolio that's diversified, resilient, forward-looking, spanning traditional and digital assets.
So it's diversification not just of assets, but of risk, growth potential, time horizons.
Exactly. All within one cohesive strategy that you can adapt. It lets you manage risk smartly while staying open to the future. That's the power.
So as we wrap up this deep dive, here's a thought to leave you with. Really understanding and applying a system like Core Satellite to your investments. It can do more than just change your portfolio. It can actually change your whole relationship with money.
Moving from fear or chasing to strategy and calm.
Right. From reactive to empowered. And thinking about that roots and wings idea beyond finance, what other parts of your life could benefit from that? Having a solid foundation that gives you the security to really explore new things, reach for bigger goals, something to think about.
Definitely food for thought. And speaking of empowering your journey, our next deep dive is going to tackle something often seen as the enemy, risk. Specifically, we're going to challenge the idea that volatility is always bad.
Ooh, interesting. So risk isn't always the villain.
Sometimes what looks scary is actually opportunity in disguise. We'll explore different kinds of risk and how understanding them can make you an even smarter investor.
That sounds incredibly valuable. It's about seeing the market not just as something scary, but as a landscape of possibilities you can navigate strategically. Can't wait for that one.
This deep dive was brought to you by Elevra, where community and capital grow together. You can learn more at elevracoin.com.
Until next time.